it's simply too early to make a judgment without having given the MySuper system an opportunity to operate. The second area of concern relates to an old debate, an old friend, which is active versus passive management in the asset management sector. So our starting point at the Financial Services Council is in a $1.8 trillion industry. It is critical that there be both active and passive management. We don't support one system over the other. We think they both have a critical role to play. But if we look at the role of active management, we are doing research which has indicated in an early sense that there are benefits to active management and that they provide benefits over and above the index to superannuation funds. That research will be with us in time for us to submit to the Murray inquiry. We don't have it at this stage. The other point is that there's a great dichotomy of debate that takes place in superannuation at the moment. There are those who will argue there must be more superannuation funds spent in infrastructure, and indeed Murray mentions that on the way through. On the other side, we have people saying there is no benefit to active management, it's too expensive. Well, you can't reconcile those two propositions. They are not reconcilable. You either have one or the other. The other, what we believe, emerging irreconcilable trend is that the demand for long-term thinking in superannuation and long-term investing, which we hold very dear, is at odds with very short-term reporting and very short-term investment thinking in superannuation. So when we have the media reporting monthly returns on superannuation, in most cases a 40-year investment for people, you're getting this juxtaposition in the marketplace of those who are responding to how MySuper's done this month, and small MySuper, my superannuation's done this month, versus hanging on for a 40-year investment. The other most significant investment we make in our lives is our family home. We don't decide to sell our house this Saturday because the place down the road sold well. It doesn't usually work that way. So we have this challenge that Murray, to his credit, is looking and struggling with respect to how do we see greater long-term investing, greater matching of assets, greater investment in infrastructure. And we would say all of that is worthy, but how do you match that with a lot of short-termism? Overriding all of this, and this is no criticism of APRA, it's just a fact, APRA is in the throes of preparing the first of what will be a regular quarterly report on the performance of MySuper products. Now, the weight of the regulator releasing that will be that it'll be extremely well reported. And people, and I have a view, we hold a view that just as the bank fees debate was a massive debate 10 and 15, 5 years ago, the superannuation fee debate will move to the front page of the newspaper and it'll be on your radio every morning, across social media. APRA won't do this, but it will be league tabled very quickly, and you'll be able to go down the list and work out where you sit, where your MySuper product sits, where your default product sits. So transparency is a good thing. It's a great thing. It's a critical thing in a compulsory superannuation system. But we cannot ignore that it could drive behaviours more and more to short-termism, much more switching of accounts. The outcome of more switching of accounts is a greater requirement for liquidity in superannuation funds, which diminishes their capacity to, back to my starting point, invest in long-term illiquid assets like infrastructure. So we have these debates that are at odds to each other happening, and Murray in some cases reflected one side of this debate without recognising the other and critical side of the debate. There's also a clear suggestion that funds management fees in Australia are too high. Our earlier research on this indicates that it's quite incorrect. Any fund manager will tell you that the Australian market, because of the nature of large, sophisticated and well-managed superannuation funds, the funds management fees here are lower for the same sorts of assets that are managed around the world. So we've looked at a number of our members and seen that, for instance, they are managing domestic equities overseas at an average of 10 basis points higher than what they manage them on average for Australian equities here. And the same applies at 5 basis points for property. Now, that's not a lot, but 5 basis points, when you're talking about a 73 basis point, and I know I'm comparing apples and oranges here a bit, but those sorts of differences are significant in a very tight market. So the argument that Australian funds manager fees are too high does not stack up either. So these are some of what I'd call the lazy and easy recommendations that have come out from Murray with which we have some concern, and we'll be making clear and analytical and well-supported recommendations back to Murray to put a greater level of fact into the debate. The one area I think that is most interesting that David Murray has reflected on is his observations of the need for a greater retirement income policy in Australia. One of the great failings I think our superannuation system has is that it has been a superb accumulation system. And our focus to date over the last 22 years has very much been on how we have accumulated. We now have to turn our focus to how we become a decumulation or retirement income system. And as I said before, David Murray has turned his mind to this. I don't anticipate that David Murray will make a massive recommendation. He might talk about annuities, he might talk about income streams, tax arrangements, there may be something around that. But what we will be looking to David Murray for is a further recommendation. God forbid I should ask a report to make a recommendation for another report, but it will be looking for much more work to be done on a retirement income or retirement outcome policy indeed for Australia. We actually don't have a retirement income policy. We have superannuation policy in Australia, but we don't have a retirement income policy. Now let me tell you why having a superannuation policy debate is dangerous. It's dangerous because it ultimately comes down to one thing, and it's a debate on tax. It's about the beginning and end of it. It becomes a tax debate. Who's getting the right tax levels? Is it fair, etc., etc. We think there's a need to elevate this debate significantly to be a debate that asks really the questions to answer this proposition. How can we ensure that with life expectancies at the moment and life expectancies predicted into the future, that people in their retirement phase will have an adequate lifestyle, adequate income, adequate health and aged care and housing? Now that's the starting point. Back from that, we ask a number of questions that go down in detail. Are the tax settings right? Now the only proper way in our view to have a tax debate is as part of that overall debate. Is 12% right? Should it be 15%? Do we adopt the Paul Keating view that he's floated in recent years that the last 3% from 12 to 15 should prepay your health and aged care into your ageing? I don't know. I don't have a view on any of these things that is emphatic, but I do have a view that these are the questions and these are the policy areas we need to concentrate on. Should we end access to lump sums in favour of compulsory annuitised, not annuities, annuitised incomes, pensions and the like? Is the pension too easy to access for certain individuals? Our view is yes. Is the preservation age appropriate? Presently at 60, our view is no. Now that's all well and good for those of us who come to work in suits and ties and don't lay bricks all day, but these are the critical questions that have to be answered in order to determine the original question, which is, can our system ensure that it provides an adequate income, adequate housing, health and ageing for people in the long period of their retirement? Now this is a challenging question, ladies and gentlemen. You know, I'm 45 years old. When I was born, people died from things they take pills for today. It's as simple as that. So the level of our capacity to predict what my 10-year-old son will be medicated for and what illnesses he will never face and what capacity we have for him to physically last well into his, as a worker, well into his 70s that don't exist today. These are questions where we have to make some brave and bold assumptions, but they're assumptions worthy of our time and effort to determine that really retiring at 65 or 70 and living for 30 or more years is a very expensive proposition. Now, the reasons it's critically important for superannuation to have the right setting is it is very clear to all of us that the government, through the provision of age pension, subsidised health and aged care and housing, simply will not be able to, without significant and probably negative changes to the taxation system, and therefore negative consequences to our competitive capacity in Australia. It's simply not conceivable that the government will be able to foot the bill alone through the provision of subsidised health and aged care, housing and pension. So we have to have a sustainable pension, and it has to be twinned with a sustainable superannuation system. So these are what we believe the critical sorts of things that need to be examined, and we're very pleased that David Murray has given a clear indication that he sees them as significant as well. Joining Rob over the bridge from life insurance to general insurance, he does raise the question quite appropriately of how big is the underinsurance issue in Australia. Now, more Australians than ever before have life insurance, ever before. That is primarily a consequence of group life insurance attached to compulsory superannuation. But what is very clear is the value of those policies is simply too small, simply too small. So having a $50,000 or $100,000 term life policy attached to your superannuation doesn't really cancel the mortgage if there should be a tragedy in the family. So our argument is that underinsurance is a real issue in Australia, and we want to link that debate, and we'll raise this very strongly again with Murray, to the capacity for life insurance to provide products and solutions that reduce the community's reliance on welfare. Now, without giving you a product flog, every individual who has income protection will be one less person who goes on potentially the disability pension should they have a catastrophe in their life. Every person with trauma insurance will be able to deal with the costs associated with their event in a manner that they would not be able to if they did not have trauma insurance, and the list goes on. So we argue that life insurance is a public good. Indeed, everybody likes to quote Churchill for any purpose, but believe it or not, he actually said in the early 1900s that there should be a great celebration for all of those people who self-support themselves by taking out life insurance, literally. I'm paraphrasing, of course, but it's interesting that, and many would argue that the UK, of course, is the home of life insurance, but, we have lost the understanding through a mandated government welfare system, which is appropriate. We've lost the understanding of the benefits that private provision through life insurance can provide. So we ask questions, such as, at the risk of being dragged into the world of community-rated insurance, should life insurance be given the same sort of tax incentives, the same sort of carrots and sticks that health insurance products are given to encourage or push people of certain income brackets into a life insurance product that will diminish their requirement in the future on any welfare? These are interesting questions for us to look at. So our view is that our general disappointment with the Murray review is it's dropped down into the weeds, as I said before. It talks about, for instance, areas that are important but not, in our view, pivotal to the financial system, such as the need for education of financial advisors and registers of financial advisors. We think they're all very important things. I just don't think they sit in the stratosphere of a financial system review. So the last thing I want to talk about relates to the big opportunity we see for the financial system inquiry, and it's why I pause for a moment to be so lavish in my praise of Mark Johnson. And that is the opportunity for the financial services sector in Australia to become a genuine trade industry for Australia. We do very little in the funds management sector, in the retirement income sector, in the wealth management sector in general, in terms of trading with our regional trading beyond our borders. That's because of the regulatory framework that's in place. The concept that many of you may have heard of an Asian region funds passport is but part of a package of reforms recommended by Mark many years ago that would open up trade opportunities for Australia. And we are very keen to see David Murray conclude his report with a clear recommendation to the federal government to complete the recommendations and the reforms outlined in the Johnson report to ensure that Australia can be, in real terms, in a serious way, a trader of financial services into the region. Thank you very much for the opportunity to give you an update. It's now my job to introduce David Lynch. So this is the buy side. Here comes the sell side. I want to get a bit more passionate at the introduction that I got. So please welcome David Lynch.
Thanks, John, for your comments, and I would like to thank the Centre too for the opportunity to participate in the event today. As the programme suggests, my focus is on financial markets, and as an overarching statement, I would like to say the inquiry's interim report, while not providing a complete framework, provides sufficient scope and direction to address the key issues in financial markets. Financial markets are an integral part of the chain of production that is the national economy. They're not separate from the rest of the economy. But actually, rather, there's a tight interdependency between the financial system and the other parts of the economy. Now, the interim report gets this right, and that's important because it sets the right framework from which to develop priorities and recommendations to guide the development of the financial system. The interim report suggests our financial markets have operated in accordance with the principles it identifies for the system to meet the needs of Australians, including during the global financial crisis period. Indeed, looking at the available evidence, I'd agree with this judgment. For example, there's been a steady reduction in transactions costs on financial markets, that's spreads and charges, since the time of the Wallace inquiry. Interest rate swap spreads, for instance, have fallen by 40% over that period. We also have an active equity capital market. Capital raising on the Australian Securities Exchange was around 7% of GDP during the global financial crisis years. And that's providing permanent financing to the economy equivalent to about 40% of the value of credit approvals of large loans in those years. In OTC markets, customer transactions are a large and growing proportion of activity in those markets. Now, that said, it hasn't all been plain sailing, especially since the global financial crisis. Indeed, there have been difficult moments in the financial markets. For example, trading in cash equities fell sharply in both real and nominal terms following the GFC, and it hasn't recovered since. So market liquidity is significantly reduced. There are specific issues for some markets. For example, in the energy area, electricity derivatives and hedging through using those products was greatly reduced because of uncertainty due to the the abolition of the carbon tax. Moreover, the cost of implementing regulatory change is high and increasing intermediation costs. So there are challenges for the inquiry to consider in improving the vibrancy of our markets. And these are important to address as it is anticipated that the balance of the financial system over time will shift more towards market-based financing. The international context is more important than ever. As we look to the future, economic growth and development in the Asian region drives a greater need for regional financial market integration. It offers new funding sources and provides opportunities for financial services exports of the type that John just referred to. Australia must be well placed to take advantage of this, and it is welcome that the inquiry has recognised these issues. Equally important is that the regulation of our financial markets is now subject to global standards to a much greater degree than was historically the case. Now, this aspect is recognised appropriately again in the inquiry, and it's something that I'll speak a little bit more on in a couple of minutes. But in essence, when you look at government policy settings, I'd make the comment that while industry's response to the economic, technological and social changes will be the key factors in driving developments of financial markets, government policy settings will also have a key influence on this. This includes the approach it adopts to regulation and taxation and promoting development of the sector. So I'd like to now consider this in just a little bit more detail. Get this right. Here we go. Beginning with regulation, look, I think it's obvious, and most people would agree, that the financial sector needs policies that are designed and then implemented in a way to serve the economy in the most efficient and cost-effective way. Simple to say, but how do you achieve that? I would agree with the observation by the inquiry that Australia's current regulatory model has served us well. The right framework is in place and our regulators have generally performed well. But going forward, we need to both protect the quality of our regulatory system and improve its performance. In doing this, we need to start at the beginning by ensuring the right public policies are put in place. Parliament needs to maintain its policy-making authority and ensure that it has access to high-quality, objective advice and to understand the implications of the laws that it's making. This will require an intellectually strong and well-resourced policy-making capability, which the Department of Treasury provides. In addition, Treasury is best placed to assess and advise government on conflict and policy objectives that occur quite frequently. Moreover, Treasury as a policy body is best placed perhaps to begin to judge the cumulative impact of regulatory reforms rather than looking at those measures individually. And in a markets context, that's quite important. The administration role of regulators is really quite separate to the policy-making role of Treasury and government. The distinction is necessary for both good policy development and the effective administration of those policies. Now, this delineation should not be compromised. Regulators should have clearly defined roles and expectations placed on them within the terms of the government's policy. The revival of statements of expectation, which are mentioned in the interim report, is a welcome development in this regard. I think there is merit in further considering an Inspector General of Regulation to review regulatory systems and procedures for administering legislation that underpins our policy. We found this worked well in the tax area. Now, moving forward, I'd like to point to, address the role of industry, if you like, in financial markets and the regulatory process. And really my comment would be that industry involvement in the regulatory process through self-regulation in appropriate cases should form part of the future regulatory fabric of the Australian system. Why do I say this? I think adopted in a flexible and innovative manner, this approach has the capacity to deliver, the capacity to improve market efficiency and give better regulatory outcomes and reduce the cost of regulation. For instance, industry bodies can develop best practice for financial market participants in relation to matters like conduct and risk management, which the regulators can then incorporate into their assessment of licensees. Done in this way, it combines a dynamic and deep understanding of contemporary business models and practices with the formal authority of the regulators. Where appropriate, this supports fair and efficient markets, one of the objectives or one of the principles identified by the inquiry. Indeed, AFMA has provided best practice guidelines on the conduct of market soundings that illustrates the potential here. So it does have practical application and I think can be developed further. Now I'd like to turn to tax settings and future reform. Clearly it's important. In my view, the tax system has too great an influence on the financial system for it not to be subject to firm recommendations by the inquiry's final report. Moreover, the effectiveness of financial markets is adversely impacted by aspects of the tax system. For example, interest withholding tax reform is recognised as a mechanism to improve competition in the financial system, but has been deferred, delayed and eventually dropped as a policy reform in recent years. However, Australia must remain attractive as a destination for mobile capital and other diversified funding options for Australian-based financial institutions and businesses. Another related problem is the need for withholding tax policy to support the G20 policy-driven objective of centralised clearing of OTC derivatives. Now, I think the inquiry should suggest that the government should strike a balance between taxation and regulatory policy that attaches a high priority to the development of the financial system. And I say this given the economic benefits that flow from a strong financial system. Further, it should adopt a coordinated whole-of-government approach to implementation of the measures by its agencies. So, for example, the withholding tax issue that arises in relation to OTC clearing would be addressed effectively. Sorry. Now, I'd like to move on to another issue and deal with some specific matters. One is the corporate bond market. The interim report has correctly identified a deeper and more liquid bond market would provide diversification benefits to issuers and investors. Deborah Ralston, in her talk this morning, made comments in relation to this, so I won't dwell on it too much. But I would like to make the comment that the goal of developing a more active or vibrant domestic corporate bond market will require collaboration by all stakeholders. That's government and industry. And in industry, you're talking about those involved in the intermediation, broking, advising, funds management areas. I think it's a long-term development issue for the financial system and will require input across all of those levels to be successful in the long run. I enjoyed the interview this morning which David Gallagher conducted with former Prime Minister John Howard. And one of the things the former Prime Minister said was he indicated in his interview that global integration is a given and we have to decide how best to use this situation. How we deal with this will affect the cost effectiveness and efficiency of our financial system for all users, business, households and indeed government. It's essential to the Australian national interest that our regulators are both well placed to contribute to the development of global standards and have the capability and confidence to make judgments in the way these standards should be applied in the Australian context. Now, the interim report observes that we've done well in this regard, and I would agree. I mean, initiatives like the Committed Liquidity Facility, which the APRA and the Reserve Bank have developed, are innovative and provide a solution that's particular to the Australian context. Similarly, there's a high cost potentially involved for the economy through the proposed treatment of margins in relation to cross-currency swaps, which tend to be not subject to central clearing because of their particular nature. In both cases, Australian regulators through international bodies were able to influence outcomes that were clearly to the benefit of the Australian financial system and indeed the economy. So there's a cost involved in these relationships, but it's necessary and ultimately provides significant benefits to the economy. Now, international standards, I think, will be generally appropriate to the Australian financial system. We are part of the global system and it makes sense in that context. But there will be situations where the timing or form of adoption of an international standard would make a material difference to the economic costs and competitiveness of our financial system. And this applies in matters well beyond the bank capital issues that currently get discussed. It certainly applies in relation to financial markets issues from time to time. So Australia's decision-making process must place greatest weight on what is the right outcome for our economy. That is bearing in regard to all of those factors. Therefore, it's important to rigorously test the relevance and applicability of global standards to Australian markets. The inquiry also makes reference to the vexing problem of extraterritoriality of regulation. Now, this problem has not near been resolved yet, and it's a very difficult issue to resolve because it involves multiple jurisdictions. I think the inquiry could highlight to the government the importance of G20 and its processes in providing systemic and outcomes-based approaches to this issue. So that's an objective leading into the G20 meetings that will take place in Brisbane later this year. Now, finally, I'd like to make comment on issues in relation to the competitiveness of Australia. Our regulatory system is one aspect of our international competitiveness, and it's one which we fare well on, but there are other aspects too. Cost recovery, for example, is a growing impost on the sector, and there's no apparent consistency of policy or logic when you look across the various levies and charges imposed on the sector. I think this is in part because the objective of cost recovery appears in some cases to be more in nature fiscal than it is to promote financial sector regulatory outcomes. I think the inquiry could contribute to the future development of our financial system by recommending to the government a clear policy on cost recovery for regulation that's driven by a focus on the beneficiaries of regulation and for a design that addresses the moral hazard issues in a way that would promote an efficient regulatory system, in other words, separate to other objectives that might be in play. Now I want to close, indeed, as John Brogden did, by mentioning the Johnson report in Australia as a financial centre. This is not coordinated, it just so happens that this is where my various thoughts get drawn together. But it's going on, I think, nearly 5 years now, and many of its recommendations are still in limbo. Look, the ingenuity and capability of our financial markets, the quality of our regulatory and legal systems, and the economic development of Asia present a great opportunity to grow our financial services exports and related income and employment. However, in truth, we've yet to deliver a convincing message to global institutions that are really willing to compete, that we will do what's necessary to fully leverage off our competitive strengths in a regional context. This commitment is necessary to build confidence in businesses to locate their operations in Australia. The interim report identifies the issues that require resolution. The final report should be forthright in its conclusions and recommendations in this area and support effective regional integration of our markets and our competitive capability to take advantage of this. In closing, let me draw my various comments together by saying it's my hope that the inquiry final report will provide the government with a clear strategic framework through which it can manage its policy priorities to best support the further development of the financial system. Thank you. Now, as I finish, I'd like to hand over to Andrea Slattery, who's the CEO of the Self-Managed Super Funds Professionals Association of Australia, and thank you for the opportunity to speak.
Thank you very much. It's a real pleasure to be here today, and thank you very much, David and CIFR, for inviting me. I feel very honoured and to be in the company that's here today. I've been asked to talk about financial advice today, and as you heard my title, we're in self-managed super funds. So I will highlight a couple of points as we go along. But the issue today is, I think, before we just go to the Financial Services Inquiry Interim Report, is the concept of professionalism. It's talked about, it's bandied about, it's something that we need to get to, and it's something that the financial services currently today isn't seen to have from an internal perspective. But when you go internationally, we're known internationally as one of the leaders in professional financial advice across the range of areas, and so we are sought out by overseas countries in some instances and in some of the areas for how it goes. But in relation to some of the challenges, we've got the speed of change with what's actually happening. The changes in relation to the regulatory changes, the barriers that are sitting there in legislation and regulation, the research that David alluded to, that we don't have enough research. There's lots of data that's building, but there's also a lot of opportunity. So when we talk about the actual financial planning sector of the financial system, we're talking about 52,000 people with the expectation that there's about 16,000 that are actually currently providing financial services. So there's a lot of issues with long-term nature of advice, but short-term issues around how you actually provide it. So those are the sorts of barriers that we're looking at. But there's been a general thought that we've got a single financial services profession. I'd like to challenge you on that. And I'd like you to think about the fact that the Financial Services Inquiry is actually asking us that same question. So when we look at industry-led reform to date, what we can do is, even today we've just had four different markets that are providing different levels of advice and different servicing and different requirements that actually suit the industry or the profession that it comes about. And so we've got a lot of research that actually shows, for instance, that there's a new SMSF profession. The professions of accounting and financial planning and insurance and law are actually the basis or the secondary profession that actually provide efficiencies to allow them to provide services at a strategic and a higher level of delivery. So there's these sorts of things that are coming, and so when we look at the financial services inquiry, we must actually look not just now and not just what we've had, but also what we've got to look for in the future and imagine where it's going to be going in the next 20 years. So we look at new opportunities, and once again, John just highlighted the fact that we're accumulation in super as an example, but the SMSF sector holds 65% of the assets of all decumulation assets in Australia, and it's this, as a system, it is very well, it's performing very well, and it's actually advised very well, and things like longevity and adequacy aren't as serious an issue as some of those in the market believe it to be. So it's worthwhile once again looking at that. Things like technology, we've already seen the changes once again in our area of advice and in the administration systems, where the fees of SMSFs has gone from 2% 10 years ago down to 0.5% 18 months ago, according to the ATO stats and other things. But there's efficiencies there where people are pre-populating, and there's significant number of services and advice that are actually being overlooked, and there's new areas of advice coming. The other challenges are self-regulation versus the regulator, and so we really need to look at the powers of the regulator and the resources that are provided for them. And I'm not just talking about ASIC, I'm talking about the ATO, who actually also has a role to play. Consumer protection, we've got to the whole issue around the FSI is to make sure that our financial system meets consumers' requirements and protects them in its own fashion, and advice structures around that must do that. So we've got those that are at the lower end of the spectrum for financial literacy and those that are at the upper end, and those that are engaged. And we've got a PhD thesis that's actually in pilot study for the last 6 years to show that good financial advice or good services through competent advice actually raises the level of financial literacy, and it allows people to be more engaged, more trusting in the information, then for better decision opportunities are available. But higher standards of professional codes of conduct and ethics are all part and parcel of it, and it's something that's very fragmented at the moment in the Australian market. So if we come back to the FSI, I believe that some of the reviewing around the financial advice was perhaps not necessarily going to be high on their priority or high on the agenda, but because FOFA hasn't quite finished, I believe it's actually taken a higher priority. And so some of the issues that they've raised are quite specific around the micro as well as the macro levels. So there's a general consensus that the quality and standard of financial advice needs to be improved. I don't think anyone can challenge that, and this week Peter Kell actually came out with a statement that said there's been an inappropriate level of quality advice in the financial planning or the financial advice market for over a decade, and that needs to change. I think it's also a case of financial advisors are only used to about 40% in the Australian nation, but if we look at the SMSF, it's actually about 42%, but you've got accountants, auditors and actuaries and other professionals that are actually much more seriously engaged, and most of those are actually engaged at closer to 90 or 98% or 99% with the consumer. So if we're going to change the quality and standard of financial advice, if we're going to improve that, then we really have got to do that through the leadership areas of training, competencies and professionalism. And so the whole aspect of that needs to have a focus around how that can happen. So the self-regulatory model versus the regulatory model, where the regulator sets the minimum education standard, needs to turn around so that the training and the competencies are actually done by the professional industry that is developed. We've seen through the RG146 a regulator getting effectively trying to manage an RG146 level of entry. People are able to then suggest to the market that they have a level of competency. The consumer believes they have a level of competency. In some instances, that's not been correct, and in many instances it has. But the whole reputational issue in Australia, and the whole reputational issue with consumers and their belief and their trust and confidence in the advice market must come through high-level competencies, appropriate training programs, and a commitment by the individual to their own professionalism. And I don't make that comment lightly. So we shouldn't have a regulated, mandated minimum with no self-regulation alongside of it, but we should have a regulator that actually has the power to supervise, monitor and penalise. And those powers are there, we just need to extend them, but we need to actually also extend the powers of self-regulation and how that can actually be built and the determination to do it. I think a couple of the particular points that were raised in the inquiry were around minimum education and competency standards for personal advice. Now, the entire market supports that. We do currently have a minimum education and competency requirement for skill and competency. That has proved to be too low. Whatever is coming needs to be more robust and valid. We don't believe in the minimum, in the introduction of a national exam for financial advisors. There's such a broad brush of professions and industry groups that actually are playing in the financial system that there is no way that you can actually introduce a national exam to meet all of those needs. So therefore, a national exam should therefore be pointed towards an occupational requirement. If it's pointed towards an occupational requirement, it's still not meeting the consumer's needs. So there really needs to be a commitment by the financial services advisors to actually raise their own professionalism. And we know from past experience that a national exam is actually a disincentive for advisors. And it's seen in the RG 146, the AFSL introduction many years ago. It's been seen in the auditors program, and it's also being seen in a number of other areas. So it's not the panacea to actually raise the level of standards. One of the things that the Financial Systems Inquiry acknowledged was actually something that SPAA has been advocating for about 8 years, and it was the concept of if you are to have a profession, then you must remove the concept of general advice. You must have a concept of the professional is the one that can provide the advice services. That is the one that the consumer can go to. If you are providing a sales or an information service, that is actually something that must be acknowledged, and therefore the trust and the confidence in the consumer can be with you, and you are doing what you do naturally. But to change the language and to interpret the language so that the gap between the consumer's expectation and that of the advice that is delivered by our language in the financial services and by our building in of something to try and meet our system, so our system of selling something or having a linkage between a product and advice, we must unbundle that and we must bundle it up into a profession. And so the whole concept of that we were really pleased with, and really pleased to see it in there. And it actually will move people towards a profession. So this also has an ability to have more engagement. More engagement means more informed decision. More informed decision means there's more awareness. It's actually a catch-22 that will allow business and the financial system to grow and benefit. What we're also seeing is the opportunity that if we can actually get it right internally, then as John said, and as Marcus is talked about in his previous papers, there's an opportunity for exporting of these services, exporting of our expertise, exporting of our efficiencies that we're gaining, because as you build your professionalism, you also build your efficiencies that sit behind you, and you can use technology to change those. And so the concept, once again, is our language. We have a language of our own in our financial system, and that language is not well understood by the consumer, and that language needs to change, and that needs to change through professionalism and actually having the consumer at the heart of what you're actually providing, and also that you're accountable for that in your own person. So to conclude, we believe very strongly that you need to have self-regulation to create a profession, and you need that profession to actually become professional and then be supervised and regulated by the regulators, so that the resources are actually going to regulate the industry appropriately, and we're not putting pressure on the current regulators as we do to actually have many, many roles, and therefore they don't have enough resources to actually be to indulge in the regulatory function when they need. We must have at the heart of anything to do with financial advice in the financial system through the Financial Systems Inquiry, consumers' protection. And that revolves around being engaged and informed. And that revolves around not just some having engagement and not just some being informed, but how can we actually deliver an efficient system where we engage those that are less financially literate or less able to pay, because a profession also allows an introduction of pro bono and other opportunities, which is very, very important for our financial system to function properly. And the last point is that we don't believe in any regulated mandated minimum of any description, competencies or exams, unless there's a development of the self-regulation that goes alongside of competencies. So minimum competencies so long as there's self-regulation and a building up of professions, but we definitely don't support the minimum exam which was popped forward. So thank you very much, David.
And also why we think